In trading, the first real battle is never with the market, it's with the trader. Every chart, every candle, every price movement is simply information. Yet the meaning we attach to that information is filtered through layers of hope, fear, hesitation, and impulse. This creates a distorted reality that leads many traders to believe the market is responsible for their outcomes, when in truth, it is their emotional responses that shape most of their decisions. Follow rules, not emotions, is more than a principle. It is the foundation on which consistent, confident, and disciplined trading is built. A trader who operates emotionally reacts to the market as if every tick is a personal statement about their worth or intelligence. A rule-based trader sees the same tick as neutral, just a moment in time. Emotions push you to chase a candle because it's moving fast, to hold a losing position because it might come back, or to exit a winning trade too early because you're afraid of losing those open profits. Rules, on the other hand, allow you to approach the market with clarity and structure. Rules define what you will do before the market moves, while emotions attempt to influence your choices after the market has moved. When you follow rules consistently, you separate yourself from the chaos of uncertainty. You create a framework that limits impulsive behavior, reduces psychological stress, and keeps your perception aligned with actual market behavior instead of emotional projections. This shift from emotional decision-making to rule-based execution is what transforms trading from a random, stressful activity into a professional, systematic process. It is the difference between a trader who survives and a trader who thrives. Emotions are not the enemy. The problem lies in giving them authority. Fear is meant to protect you, but in trading, it often protects you from opportunities. Greed is meant to motivate you, but in trading, it pushes you beyond your limits. Hope feels comforting, but in trading, it traps you in losing positions. Rules remove the emotional stories and leave you with objective steps. A rule tells you when to enter, when to exit, how much to risk, and how to analyze the outcome. This allows you to respond instead of react, evaluate instead of panic, and grow instead of chase. Many traders believe that mastering the market means mastering complex indicators or secret strategies. In reality, mastery begins with mastering yourself. When you commit to following your rules without negotiation, you begin to trust your own process. That trust builds confidence, and confidence strengthens discipline. Over time, the market becomes less threatening, less confusing, and less personal. You begin to see its movements as natural, not dangerous. You stop fighting random outcomes and focus on executing your plan. Following rules is not about eliminating emotions. It's about preventing emotions from making decisions for you. Once you accept that your trading edge comes from disciplined action, not from predictions, opinions, or impulses, you begin to trade with a sense of control and stability. And that shift changes everything. Discipline creates consistency, and in trading, consistency is the only bridge that connects intention to results. Many traders believe consistency is something the market gives them, as if stable outcomes emerge from stable conditions. But the market is never stable, never predictable, never obligated to behave in a pattern that fits anyone's expectations. Consistency is not found in the charts. It is created within the trader. It comes from disciplined actions repeated with unwavering commitment, regardless of the emotional pressures that arise in the moment. When a trader understands that discipline is not a restriction but a structure, everything about their performance begins to shift. Discipline becomes the lens through which they interpret risk, form expectations, manage uncertainty, and execute decisions. A trader without discipline may have a great strategy, strong technical knowledge, and even years of experience, yet still struggle. That's because knowledge alone doesn't create consistent outcomes. Only consistent behavior does. You can take the same setup today and tomorrow, but without the discipline to follow rules exactly the same way each time, the outcome becomes random. The setup itself didn't stop working. The trader's behavior changed under emotional pressure. Markets expose inconsistency instantly. One moment of hesitation, one impulsive exit, one trade taken because of impatience, and the entire structure collapses. This is why discipline is the foundation. It is what turns a strategy into a system and a system into a long-term edge. Discipline is also what allows a trader to operate without relying on certainty. The human mind naturally seeks patterns, predictions, and emotional comfort. When faced with uncertainty, the instinct is to protect oneself, either by avoiding trades, forcing trades, or altering rules to reduce discomfort. But trading thrives on uncertainty. Every trade carries an unknown outcome, and every moment presents the possibility of loss. Discipline is the internal mechanism that allows a trader to remain stable inside that uncertainty. Instead of reacting emotionally to the unknown, a disciplined trader relies on predefined steps. They don't need to know what will happen next, they only need to know what they will do next. This subtle shift from needing certainty to trusting process is one of the most powerful transformations a trader can experience. Another aspect of discipline is neutrality. Consistent traders are not emotionally attached to individual outcomes. They don't celebrate wins excessively, and they don't personalize losses. They treat each trade as one event in a long series, knowing that no single result defines their skill or future. Without discipline, that neutrality becomes impossible. A trader may start following rules, but after a big win, excitement tempts them to increase risk or skip confirmations. After a loss, fear pushes them to tighten stops or avoid valid setups. These fluctuations create inconsistency, and inconsistency destroys statistical edges. Discipline stabilizes emotional waves so decisions remain objective. The trader's identity is not tied to the outcome, it is tied to the quality of execution. This is how consistency is born. Discipline also protects traders from the illusion of control. The market often gives random reinforcement, bad behavior rewarded with profit or good behavior punished with loss. These moments can mislead a trader into abandoning rules. A disciplined trader understands that a profitable outcome does not validate an undisciplined action. They know that following rules during losses is more important than breaking rules during wins. This mindset prevents the ego from hijacking the process. Many traders lose discipline because they confuse luck with skill. Discipline prevents luck from distorting their perception. It ensures that the trader measures performance based on adherence to rules, not short-term financial results. This subtle distinction shapes long-term success. Another critical layer of discipline is structure. Consistent traders build structure into every part of their process. Entry criteria, risk limits, stop placement, management rules, exit conditions, journaling routines, review sessions. Structure removes the mental burden of decision-making in the heat of the moment. Without structure, the trader must constantly interpret, adjust, and evaluate during live market conditions, which amplifies emotional influence. With structure, decisions are predetermined. The trader simply executes. This reduces stress, increases clarity, and creates a reliable rhythm. Over time, that rhythm becomes the trader's identity, steady, focused, and unaffected by short-term fluctuations. Discipline also helps a trader respect risk. Many traders understand risk management intellectually but fail to apply it consistently. They plan to risk 1% per trade, but after a losing streak, fear makes them cut it to 0.2%. After a winning streak, greed pushes them to jump to 5%. These emotional adjustments destroy the balance of probabilities. Discipline forces the trader to maintain risk parameters, regardless of emotional states. This consistent risk application allows the law of large numbers to work in their favor. It creates long-term stability even when short-term results seem chaotic. Without disciplined risk management, even the best strategy can become a source of emotional pressure and financial damage. Discipline is not rigidness. It is flexibility within boundaries. A disciplined trader can adapt to changing market conditions, but adaptation happens through rules, not impulses. They might adjust a strategy over time, but only after reviewing data, spotting patterns, and confirming evidence. They do not change rules mid-trade. They do not rewrite plans to avoid emotional discomfort. They evolve through structured reflection, not momentary impulses. This balance, structured flexibility, is what keeps them aligned with reality while maintaining internal stability. The development of discipline is not automatic. It requires conscious effort, self-awareness, and the willingness to confront personal flaws. Trading acts like a mirror, reflecting impatience, fear, ego, overconfidence, and insecurity. Discipline is the tool that helps the trader manage these internal forces rather than be controlled by them. Each time a trader follows a rule despite emotional resistance, they strengthen internal authority. Each time they break a rule, they reinforce emotional control. Consistency grows from this tug of war. Discipline is the force that determines the winner. Ultimately, discipline gives the trader something the market cannot take away: control over their own actions. The market may fluctuate, surprise, trap, accelerate, reverse, or trend unexpectedly, but discipline anchors the trader to their plan. It provides reliability in an environment built on uncertainty. It allows the trader to build confidence not from outcomes, but from behavior. With disciplined action repeated over time, consistency becomes an inevitable result rather than a hopeful desire. Emotions distort market perception because they alter the way a trader interprets information, evaluates risk, and responds to price movement. The market itself is neutral, offering an endless stream of data without judgment or intention. Yet the trader's internal state can turn that neutral data into something threatening, promising, or personal. When emotions become the filter, what the trader sees is no longer the market. It becomes a reflection of their fears, hopes, and biases. This internal distortion is subtle, often unnoticed, yet it influences nearly every decision a trader makes. Instead of responding to the actual structure and behavior of price, the trader reacts to an emotionally charged interpretation of that structure, leading to inconsistent decisions and unpredictable outcomes. Fear is one of the strongest distortive forces. When fear is active, the trader sees danger where none may truly exist. A normal pullback appears like the beginning of a collapse. A small candle against the trend feels like a major reversal. A valid entry setup suddenly seems too risky even though it met every rule. Fear narrows attention, making the trader focus on potential loss instead of potential opportunity. This creates hesitation, second-guessing, and premature exits. Under the influence of fear, the trader misreads the market not because the chart changed, but because their internal state changed. What should have been a straightforward execution becomes a struggle between logic and survival instincts, with instincts often taking the lead. Greed is equally distortive, but in the opposite direction. Instead of seeing risk clearly, greed magnifies opportunity and minimizes danger. When greed is active, every candle looks like the beginning of a big move. The trader starts focusing on what they could gain instead of what they could lose. This pushes them to take trades outside of their plan, increase position sizes, ignore stop-loss rules, or hold on to trades long after the market has given signals to exit. Greed tricks the trader into seeing patterns that aren't actually there, or into believing the market will continue simply because they want it to. This creates a distorted perception where potential profits overshadow objective analysis. Hope is another emotional force that distorts perception, particularly when the trader is in a losing position. Hope delays acceptance of reality. A losing trade becomes not done yet, even when evidence clearly shows that the market has moved against the trader's initial idea. Instead of responding to the price action, the trader responds to the emotional need for the trade to turn around. Hope creates a fantasy version of the chart where price will reverse just because the trader desires it. This form of distortion can cause traders to hold losses far longer than planned, turning small, manageable losses into large, destructive ones. Hope also distorts winning trades by making the trader stay too long, believing the market will keep giving without any structural reason to support that belief. Overconfidence plays its own role in distorting perception. After a series of wins or a particularly large profit, the trader may begin to see the market as easier than it truly is. Their perception shifts from analytical to assumptive. They begin to trust intuition over rules, believing that recent success is proof of being in sync with the market. This leads to misinterpretation of signals, taking trades without confirmation, and risking more than planned. Overconfidence blinds the trader to warning signs that would normally be obvious. It creates a version of the market where every setup seems favorable and every decision seems justified simply because the trader feels empowered from recent outcomes. Another emotional distortion comes from attachment to outcomes. When a trader becomes emotionally attached to being right, their perception shifts from what the market is showing to what would confirm their ego. They look for information that validates their position and ignore evidence that contradicts it. This confirmation bias distorts analysis, making the trader interpret the chart in a way that defends their view rather than reflects market reality. Even clear signals such as trend breaks, momentum shifts, or volume changes can be dismissed because acknowledging them requires admitting the initial idea was wrong. This distortion leads to stubbornness, revenge trading, or doubling down on losing positions. The pressure to recover losses also distorts perception. After a string of losing trades, the trader sees opportunities differently. Instead of evaluating setups objectively, they view them as potential savers or comeback trades. The emotional need to get back to break-even transforms ordinary price movement into something loaded with personal value. Trades are no longer chosen for their quality, but for the emotional relief they promise. This pressure skews judgment and reduces discipline, often leading to rushed decisions, forced trades, and increased risk-taking. Even boredom can distort market perception. When a trader feels impatient or disengaged, normal price movement might appear as an opportunity, simply to alleviate that boredom. Noise begins to look like signals. Minor fluctuations look tradable. The trader sees potential where none exists because they are responding to internal restlessness rather than external structure. This leads to overtrading, one of the most common symptoms of distorted perception, and makes the trader vulnerable to randomness. All these emotional distortions have a common theme. They cause the trader to misinterpret neutral market information as something personally meaningful. Price movement becomes tied to self-worth. Fear of loss becomes fear of being wrong. Opportunity becomes tied to greed, and randomness becomes tied to impatience. The chart may stay exactly the same, but the trader experiences it differently based on their emotional state. This creates inconsistent perception, and inconsistent perception produces inconsistent decisions. The trader might believe they are analyzing the market, but in reality, they are analyzing their emotions projected onto the market. This projection changes how they see support and resistance, how they view risk, and how they interpret momentum. It affects timing, confidence, judgment, and expectations. When emotions distort perception, even the best strategy becomes unstable because the trader is no longer responding to objective conditions, they're responding to internal impulses. To trade effectively, perception must be aligned with what the market is actually doing, not what emotions want it to be doing. Emotions don't just influence behavior. They alter the very lens through which the trader views the market, shifting clarity into confusion and structure into chaos. Rules define actions before uncertainty appears because they anchor the trader's decisions in clarity rather than emotional reactions. When a trader enters the market without predefined rules, every moment becomes a negotiation with fear, impatience, hope, or confusion. The mind tries to interpret the market in real time while also managing internal pressure. This combination creates a chaotic decision-making environment where choices are driven by temporary emotions rather than structured logic. Rules eliminate this chaos by giving the trader a predetermined roadmap. Instead of deciding what to do in the heat of the moment, the trader already knows what must be done, reducing emotional influence and increasing consistency. Without rules, the trader is forced to constantly interpret shifting information. A candle forms. A wick appears. Volume spikes. Price approaches support. Each movement demands a decision, but decisions made in real time under pressure are rarely objective. The market moves quickly and emotions respond even faster. The trader begins to see threats in normal retracements, opportunities in random spikes, and patterns where none exist. Rules prevent this by defining the criteria for action long before the chart begins to move. They act as filters, highlighting only what is relevant and removing everything that distracts or misleads. Rules also protect the trader from the illusion that each moment requires a decision. Many traders overtrade because they feel compelled to act whenever the market moves. They see candles forming and believe they must respond. But the market produces endless movements, most of which have nothing to do with the trader's strategy. Rules narrow focus by telling the trader exactly which conditions matter and which do not. They transform noise into structure. Instead of reacting to every fluctuation, the trader waits for specific signals defined ahead of time. This waiting is not passive, it is disciplined alignment with a system that has proven value. By choosing in advance what qualifies as a valid opportunity, the trader avoids impulsive behavior. Another function of rules is to remove ambiguity. Ambiguity is one of the greatest sources of emotional stress in trading. When the trader doesn't know what they're supposed to do, emotions fill the gap. The mind starts asking, should I enter now? Should I wait? What if it reverses? What if I miss this move? These questions trigger emotional conflict because the trader is trying to create certainty in an uncertain environment. Rules answer these questions in advance. They state clearly when to enter, when to avoid entering, how much to risk, where to place stops, when to adjust positions, and when to exit. Without needing to think, the trader simply executes the process. Rules also create consistency because they ensure the trader behaves the same way in similar situations. Without rules, decisions are based on mood, confidence, stress, or recent outcomes. A trader might take a setup today but avoid the same setup tomorrow because of fear triggered by a previous loss. This inconsistency destroys the statistical edge of any strategy. Markets reward long-term patterns of behavior, not random impulses. Rules enforce that pattern by requiring the trader to take the same actions whenever the same conditions appear, regardless of how they feel at that moment. This repetition is what allows probabilities to work in the trader's favor. Another important aspect of rules is that they predefine risk. Uncertainty becomes much easier to handle when risk is known beforehand. Traders without rules often adjust position sizes based on emotions. They increase risk after a win because they feel confident, or they decrease it after a loss because they feel scared. This emotional manipulation of risk leads to inconsistent results and makes the trader vulnerable to both euphoria and panic. Rules lock in risk parameters so that every trade aligns with the trader's long-term plan. By deciding in advance what percentage of capital to risk, where to place the stop, and when to move it, the trader removes emotional bargaining from the equation. Rules also strengthen discipline. It is easier to be disciplined when the guidelines are clear and objective. Many traders struggle because they rely on vague rules like "I'll exit if the market looks weak" or "I'll enter when it feels right." These emotional rules are impossible to follow consistently because they change with mood and mental state. Objective rules, on the other hand, provide measurable conditions that leave no room for subjective interpretation. When the trader knows exactly what to look for, discipline becomes a matter of execution, not emotional negotiation. Another role of rules is to limit cognitive load. Trading requires fast thinking and the ability to interpret multiple variables simultaneously. Without structure, the trader's mind becomes overwhelmed, especially during volatile moments. Overwhelm leads to panic, hesitation, or impulsive decisions. Rules simplify the process by reducing the number of decisions required. Instead of analyzing every detail, the trader focuses only on whether the predefined criteria have been met. This reduces mental fatigue and prevents emotional overload. Rules also support emotional detachment. When a trader follows a plan, the outcomes of individual trades become less personal. Wins and losses are seen as natural variations within a statistical process. Without rules, every outcome feels personal because each decision feels like a test of intelligence or judgment. Rules separate the trader's self-worth from the result of any single trade. They create a buffer that protects the trader from taking outcomes emotionally. With this emotional distance, perception remains clearer and decisions remain more grounded. Rules also help eliminate regret. Traders often experience regret when they make spontaneous decisions that turn out poorly or when they fail to act on valid opportunities. Regret then fuels emotional turbulence that affects the next series of decisions. When rules guide the process, regret diminishes because choices were made for logical reasons, not emotional impulses. Even if a trade loses, the trader knows it was taken according to the plan. This reinforces confidence and prevents emotional deterioration. Rules also prepare the trader for unexpected market behavior. When volatility increases or direction changes suddenly, emotions react instantly. Fear may encourage premature exits, while greed may compel the trader to hold too long. But when rules dictate how to respond to volatility, whether through trailing stops, partial exits, or standing aside, the trader avoids panic-driven reactions. Rules serve as an anchor during turbulence, turning unpredictable markets into manageable patterns of behavior. Rules also reveal strengths and weaknesses. When behavior is structured, it becomes easier to evaluate performance. The trader can review the plan, compare it with execution, analyze mistakes, and make improvements. Without rules, there is nothing to measure. Everything becomes subjective, making progress impossible to track. Rules create a foundation for growth because they turn trading into a repeatable process rather than a series of emotional reactions. Rules define actions before uncertainty appears because uncertainty will always appear and emotions will always attempt to influence decisions. The trader who prepares in advance creates an environment where clarity prevails over impulse, structure over chaos, and consistency over randomness. Process matters more than predictions because the market is an environment built on uncertainty, and no amount of analysis can eliminate that uncertainty. Predictions attempt to control or anticipate what the market will do next, but the market is not obligated to behave according to anyone's expectations. A trader who focuses on predictions is constantly trying to force clarity where none exists, while a trader who focuses on process accepts uncertainty and builds a structured method to navigate it. Process is reliable because it is within the trader's control. Predictions are unreliable because they depend on forces outside the trader's influence. The moment a trader shifts their focus from guessing outcomes to executing a method, they move from emotional trading to professional trading. A prediction-centered mindset creates pressure. When a trader believes they must know what will happen next, they attach their identity to being right, Every trade becomes a test of intelligence, and every market movement becomes a threat to their ego. This emotional burden distorts perception. If price moves against their prediction, fear and self-doubt arise. If price moves in their favor, overconfidence and greed take over. The trader becomes reactive, unstable, and vulnerable. Their decisions fluctuate based on how strongly they believe in their prediction rather than on objective rules or consistent execution. This instability is what causes many traders to abandon valid setups, chase impulsive entries, or hold losing trades far longer than they plan. In contrast, a process-centered mindset carries no emotional weight. A process does not require certainty, it only requires execution. The trader does not need to be right about the future because the process defines what to do when specific conditions appear. There is no pressure to predict tops or bottoms, no need to anticipate perfect turning points, no obligation to foresee every movement. The trader simply follows the structure they created beforehand. Instead of worrying about what the market will do, they concentrate on how they will respond to whatever it does. This shift removes the emotional burden that predictions create and replaces it with clarity and confidence. A prediction-based trader often feels anxious before entering a trade because they are unsure whether the market will align with their expectation. This hesitation leads to late entries, missed opportunities, or impulsive decisions driven by fear of missing out. A process-based trader does not experience this level of anxiety because the entry is defined by predetermined criteria. They know exactly what conditions must appear before they act. When those conditions appear, they enter without hesitation. When they do not appear, they simply wait. Process removes the emotional guessing game and replaces it with mechanical precision. Predictions also cause traders to abandon their strategies prematurely. After a few losing trades, a prediction-focused trader may assume their method is no longer working and immediately start searching for new indicators, new patterns, or new strategies. This constant switching prevents long-term growth and makes it impossible to gather meaningful data. The trader becomes trapped in a cycle of endless experimentation, always seeking the next secret that will allow them to predict the market more accurately. A process-based trader understands that losses are a natural part of the game. They evaluate their setups over large samples, not a handful of trades. Instead of trying to eliminate uncertainty, they work on mastering execution within their system. This stability is what allows them to refine their edge over time. Another challenge with predictions is that they often encourage emotional storytelling. Traders begin to justify trades based on narratives rather than structure. They create reasons to believe the market will go up or down, forming arguments that support their bias. These narratives become dangerous because they disguise emotional impulses as logical analysis. Once the trader becomes attached to a prediction, they start filtering information to support it. Warning signs are ignored, conflicting signals are dismissed, and risk boundaries are stretched. The trader becomes blind to reality because they are overly committed to their forecast. A process-centered trader avoids this trap entirely because decisions are not tied to narratives but to rules. If conditions do not match the criteria, no trade is taken, regardless of what the trader hopes or believes. A prediction-focused mindset also makes it difficult to manage losing trades effectively. When the trader believes their prediction must be correct, they may hold on to losing positions, hoping the market will eventually reverse. This hope turns small losses into catastrophic ones. They may even add to losing positions because they want to validate their initial forecast. In contrast, a process-based trader has predetermined stop-loss rules that are executed automatically. They do not argue with the market because their plan already defines when the trade is invalid. There is no negotiation, no emotional bargaining, and no attachment. The loss is accepted as part of the process, and the trader moves on with clarity. Process also supports risk management far better than predictions do. Prediction-driven traders risk more when they feel confident and risk less when they feel uncertain. This emotional fluctuation leads to uneven position sizing and inconsistent outcomes. A process-based trader uses fixed risk parameters that do not change based on how confident they feel. Every trade is treated as one event within a larger series. This consistency stabilizes performance and protects the trader from emotional extremes. It ensures that a single emotional decision does not destroy weeks or months of discipline. In addition, process helps the trader observe the market more accurately. When the goal is prediction, the trader looks at the market through a narrow lens, searching for evidence that confirms their expectation. When the goal is process, the trader views the market with neutrality. They simply observe what is happening without attaching personal meaning or emotional interpretation. This clarity allows them to recognize patterns, shifts in momentum, changes in volatility, and developing opportunities more effectively. The absence of emotional bias sharpens intuition over time, not in the mystical sense, but in the sense of pattern recognition based on experience and repetition. A process-based approach also creates psychological resilience. Predictions lead to emotional volatility because the trader feels responsible for outcomes they cannot control. When they're wrong, their confidence collapses. When they're right, they feel invincible. This cycle prevents long-term consistency. But when the trader commits to process over predictions, their confidence comes from actions, not outcomes. They measure success by how well they followed their rules, not by whether a trade won or lost. This mindset allows them to remain grounded, focused, and stable regardless of market results. Losses become data, not emotional wounds. Wins become confirmation of discipline, not justification for overconfidence. Ultimately, predictions feed the emotional side of trading, while process feeds the professional side. The trader who relies on predictions is always reacting to the market, while the trader who relies on process is always prepared for the market. Process brings consistency, discipline, clarity, and long-term growth because it centers the trader's attention on what they can control, their behavior, their method, and their reaction to price rather than their attempt to guess it. Confidence grows from obeying your system because confidence in trading cannot be borrowed, faked, or forced. It has to be built through repeated action, and that action must come from a structure the trader trusts. When a trader builds a system, defines rules, risk parameters, criteria, and processes, they create a framework that guides behavior in any market condition. But merely creating a system is not enough. The real confidence comes from following that system consistently, even when emotions push in the opposite direction. Every time the trader obeys their rules, they reinforce internal authority. Every time they break their rules, they weaken that authority and feed uncertainty. Confidence is not the result of winning trades. It is the result of disciplined behavior repeated until the mind believes in its own reliability. A trader who does not follow their system cannot trust themselves. Even if their system has a statistical edge, the trader will doubt every decision because their behavior is unpredictable. They might enter early one day, late the next, skip valid setups, or take random impulse trades. This inconsistency creates confusion and self-doubt. The trader never knows whether a loss happened because the system failed or because they failed to follow it. This uncertainty erodes confidence, making every decision feel stressful and every trade feel emotionally heavy. Without the foundation of rule-based behavior, confidence cannot form because there is no internal stability. When a trader obeys their system consistently, they begin to see the power of structure. They start to notice how the system protects them from emotional traps. Revenge trading, overtrading, chasing moves, hesitating at entries, holding losers too long. By following rules, the trader experiences firsthand how many bad outcomes are avoided. This alone begins to build confidence, not from results, but from the experience of control. The trader realizes they can depend on their own actions, regardless of what the market does. This self-dependence becomes a psychological anchor that stabilizes decision-making under uncertainty. Obeying the system also builds confidence through repetition. Every trade executed according to rules reinforces mental pathways that support discipline. Over time, the trader begins to act automatically without emotional resistance. The mind stops negotiating, stops arguing, stops hesitating. It simply follows the structure. This level of automation comes only from repetition, and repetition only becomes consistent when actions are rule-driven. As the trader performs these actions again and again, confidence becomes a natural byproduct. It grows quietly, steadily, because the trader is proving to themselves that they are capable of disciplined execution. Another reason obedience builds confidence is that it creates measurable results. When the trader follows the system faithfully, they can evaluate performance accurately. They can analyze data, identify patterns, refine entries, adjust stops, and optimize management because they know the data reflects the true system. This objective feedback strengthens confidence because it gives the trader a sense of progress and mastery. Without following the system, performance becomes random, impossible to assess, and impossible to improve. Clarity disappears. Confidence collapses because the trader has nothing firm to stand on. Following the system also reduces emotional pressure. When decisions are made based on rules, there is less room for guilt, regret, or self-blame. Whether a trade wins or loses, the trader knows they executed correctly. This removes the emotional burden that drains confidence. A trader who constantly breaks rules is always at war with themselves, always dealing with the guilt of impulsive decisions or the frustration of missed opportunities. This internal conflict weakens confidence more than any losing streak. Obeying the system removes this conflict because the trader begins to act in alignment with their goals, not against them. Another important factor is that obedience builds predictability. The trader starts to predict their own behavior. They know how they will respond to setups, how they will exit trades, how they will handle losses, and how they will manage risk. This self-predictability creates a sense of personal stability. Markets are unpredictable, but the trader is not. The trader becomes the constant in a variable environment. This internal consistency is one of the strongest sources of confidence because it allows the trader to stay grounded even when volatility increases or outcomes fluctuate. Following the system also trains emotional resilience. Every time the trader experiences a loss while obeying their rules, they reinforce the truth that losses are a normal part of the process. They begin to detach emotionally from negative outcomes because they see that the loss was not a failure of discipline, but simply a statistical event. This detachment is crucial for confidence. It allows the trader to continue executing their system without fear of the next trade. When a trader breaks rules, each loss feels personal and painful, damaging their confidence with every mistake. When they follow rules, each loss feels manageable and expected, allowing confidence to grow even through drawdowns. Obeying the system also strengthens the trader's relationship with risk. Most traders fear risk because they cannot control their behavior around it. But when risk is predefined, consistent, and respected through rule-based execution, the trader learns to accept it calmly. They know exactly how much they can lose, and they trust themselves not to exceed that limit. This trust is a direct source of confidence. When the trader fears their own lack of discipline, risk becomes terrifying. When they trust their discipline, risk becomes simply a number within a structured plan. Another reason confidence grows from following the system is that discipline creates a sense of identity. The trader begins to see themselves differently, not as someone who reacts emotionally, but as someone who adheres to a process. This identity reinforces behavior. Every rule followed strengthens the trader's belief that they are capable of mastery. Every disciplined action adds to the internal narrative of competence. This identity shift is powerful because it sustains confidence even during difficult periods. The trader no longer sees themselves as fragile or inconsistent. They see themselves as structured, committed, and capable of trading professionally. Finally, obedience to the system creates momentum. Each disciplined day builds on the last. Each correct action makes the next one easier. Each week of consistent execution reinforces the trader's trust in their process and in themselves. Confidence doesn't appear suddenly, it accumulates. It grows slowly through hundreds of small decisions made correctly. It grows through discipline, adherence, repetition, and respect for the system. And because it is earned, not imagined, it becomes unshakable.